Hello, everybody. Back on video again. And as is our commitment to try and keep our clients and our friends informed, I've just put together another brief video presentation for you. I just sort of thought that, look, every time I turn the television on in this room and every time I look around, I flick through the internet, all I can find is bad news, doom and gloom about how bad things are. What I wanted to do today was just to quickly run through a couple of things that are actually working to help your portfolio at the moment. I think these are things that are often overlooked, and conceptually they're sometimes a little bit difficult to explain, but I just wanted to take a little bit of your time. I think one of the things that quite a few of us have at the moment is actually time. So I just wanted to quickly run through this and explain to you just a couple of the things that are actually working in your favour that a lot of us aren't necessarily aware of. Now, I've called this little presentation some more basics because I did another little basics yesterday, but I thought today I'd just sort of take these two factors that are actually working really well to a better position. So what it's all about is there's just these couple of things that are actually working in favour of investment accounts. And the first one of these is fixed interest, and the second is currency. So I just want to explain these concepts for you so you can actually get a feel for how they are actually adding value and improving the end outcome on investments. So let's talk about fixed interest. Now, nearly all super funds, all investment portfolios have some component dedicated to fixed interest investments. Now, these are not always the kind of investments that you might think of. When we talk about fixed interest investments to clients, they mainly think about a term deposit. Now that's kind of standard because that's the way that I would think about just, I want to put my money into a fixed term investment, and that would be a fixed interest investment, like a term deposit. But most of our managers that manage money in super funds and in portfolios don't actually invest in term deposits. They may, but the predominance of their investments in the fixed interest area will be into bonds. Now, bonds is an instrument of debt, and it gets issued to a person who becomes called the bond holder. The bond is actually a debt security under which that issuer owes the holder some money, and depending on the terms of the bond, is obliged to pay them interest, which is called the coupon, from the date that the bond is issued until a later date, which is called the maturity date. So it's quite common that you would hear of these things as being, for example, 10-year government bonds. And a 10-year government bond is a bond issued by the government, be it the Australian government, a state government, whoever, and it is issued for a term, and during that term, the holder of that bond will receive interest payments. Bonds are issued by all kinds of different groups, councils, governments, companies, lots and lots of big groups all around the world issue bonds. Now, what most people don't know is that a bond is actually a tradable security. So you can buy a bond when that government or company issues it, or you can buy and sell these things on an open market known as the bond market. Now, in actual fact, the global bond market is larger than global share markets. There's more bonds traded in a day than there are shares. And bonds are essentially rated by the amount of risk that they have. So a very safe bond could be considered to be something like a US Treasury bond, which is backed by the second largest economy in the world. And so that would be deemed as being a very safe bond. And then bonds get rated down from there. So you might often hear of the Australian government wanting to maintain our AAA rating. That's because that's the group Standard & Poor's who actually rate bonds, and they will rate it according to the security that backs it. So Australian government, US government bonds are often rated AAAs. And if you wanted to get a bond from, say, Argentina or Panama, you might find that it's rated a BB or a BBB- or that type of rating. So the interesting characteristic of a bond is that when interest rates go up, the value of bonds falls. And when interest rates go down, falling interest rates, the values of bonds rise. Now, that might be a little bit counterintuitive to us as to just how does that happen. So I want to just take you through a bit of an example here. And so what I'll say is that I'm Andrew and I'm a bond investor. Now, what I've actually done is I've just gone out and bought myself a US Treasury bond. I bought it on issue from the government, from the US government, and it's a 10-year bond. I bought it and it's paying a 1.5% interest rate. And I bought this bond at the end of last year. Now, I actually think I'm pretty clever. I've got a very safe and secure investment. It's going to pay me a guaranteed interest rate for a period of 10 years. And then at the end of the 10 years, the money that I spent for that bond, say it was $100, well, I'm going to get that $100 back. So what happens next? What happens next is that the Reserve Bank, or the Federal Reserve in the United States, just after I bought my bond, made a decision to cut interest rates by 1%. Now, this is what we've seen around the world, where we've seen rates being cut. Now, what that means is that if I wanted to buy a new bond, I'd be only getting a 0.5% interest rate, but I'm actually holding a bond that's actually delivering a 1.5% rate. Now, the next stage of my life, and we roll along, is along comes my mate Tony. Now, Tony wants to invest in bonds as well, but he's a little bit disappointed because he goes to the Treasury and the only bond that he can buy has a return of 0.5%. So Tony's pretty clever. So he says, well, hang on a second. These are instruments that can be bought and sold. Andy, I want to buy your bond. So I sort of go, oh yeah, okay, I'll happily sell my bond to you, Tony. I'm still here holding it. I've got my, it's a negotiable piece of paper. It can be bought and sold to anybody. Now, from there, I start to have a little bit of a think about this, because I think, well, hang on a second. My bond cost me $100. And Tony's telling me now, look, it's okay, I can take it off my hands for $100. But then I start thinking to myself, look, if I sell my bond to Tony, what I paid for it, and get my $100 back, then I'm in his position. All I can do is then put my $100 in at a 0.5% rate. So why would I give up my bond that's paying a 1.5% interest rate to have to go and buy another one that would only pay 0.5? And the answer is pretty simple. That I go back to Tony and I tell him, Tony, I'll tell you what I'm going to do for you, mate. You can have my bond, but you're going to need to pay me $120 for it, because it's more valuable now because the interest rates have fallen. So when interest rates fell, the return of the value of my bond rose because it's got a coupon rate that's better than I can get in the marketplace. So if we all held bonds in our portfolio, the interest rates down to 0.25%, the value of our bonds inside that portfolio is now more relatively valuable. Now, some of the managers are having difficulty pricing bonds in a very volatile market at the moment. But when we come through all this, these bonds that are having higher rates of return are going to become more valuable. Secondly, I want to just turn to currency. Most portfolios invest money for clients in offshore share markets usually, and in bond markets, but usually share markets, into Europe, United States, Asia, etc. These investments have to be denominated in the currency that in the country that they are domiciled. So if I want to buy US shares, I need to buy US shares in US dollars. So when the Australian dollar goes up in value, the value of my offshore investment falls. So just to restate that, if I am investing into a share market in the United States, and I find subsequent to that investment that the dollar goes up in value, then it's hurting me to hold that investment. So conversely, when the Australian dollar falls in value, the value of my overseas investment goes up. Now, what we've seen over the past month has been that I'm looking here at a chart that shows you the performance of the Australian dollar versus the US dollar between the 24th of February and today. And what you can see is that the Australian dollar has fallen from a high here of 66 cents where it was, all the way down here. It got as low as about 57, but It's now come back up here to around about 59. So the fall in the value of the Australian dollar actually enhances the value of those offshore investments. And so much so that some of the investments held in Asia, where the markets haven't fallen that badly, the value of the share investments in Asia in the last month or two have actually gone up, not due to the fact that the markets have gone up, but by virtue of the fact that the Australian dollar has fallen. So, look, we've got positively fall interest rates. Those low interest rates mean our securities that we hold at higher rates are more valuable. And secondly, the currency has weakened off, and that has helped us during this period. Now, if the currency starts to improve, your fund manager will start to implement hedging to make sure that the portfolio maintains its value. So look, they're just a couple of quick things. I know we've got a little bit of time on our hands. I hope that's helpful for you. I want to, in this video series, just stay in touch, let you know that these are the sort of things that we're thinking about all the time. We're here for you. We're available. If you need anything, reach out. If you need any information in relation to government stimulus, how it's going to affect you, need any information on portfolios, investments, making decisions, just make sure that you reach out. We're certainly available. Please forward this video series on to anybody that you feel will get benefit from it. We're here to help everybody, and we want to get as wide a broadcast as we possibly can. Stay safe, look after your health, look after your parents if they're around and possibly you know, at risk, and take it easy. Look forward to talking to you in the very near future. And as I said, we'll keep rolling out information. Thanks again for paying attention. I know these are a little bit long, but I think that in the end, they were going to be worth it because we're going to be better educated. Thanks again, and see you soon.